we're live.
Oh, I appreciate you recording.
I'll upload the other
Now-
one too. I don't know if I did.
Oh yeah, you didn't, but I'd appreciate it if you did.
Yeah, it's gonna cost you 10 soul.
That's a steep cost.
Yeah, I'll give you a deal. 20.
9.
Klutch, are you talking on a microwave today?
He is.
Am I talking in it? Does it sound bad?
Sounds like you're talking
It's worse
through a
than
shoe.
usual.
Okay, hold on.
Holding true to his box.
He actually has a box head on right now.
Yeah.
That's why it sounds so muffled.
All right.
He's got
Does
the
that
radio
sound
on.
better?
A little bit, a little bit.
Okay, well, I just took my headset off, so I hope it sounds better.
Oh yeah, it does. That sounds.
Just gonna give it a minute because we early.
All right. Well, I will be back, but just ping me when you're done. If I'm
You
not
Okay, I
always
think-
say
in
that.
it,
You always say that, Dan. You always say you'll be back.
I'll be right back.
I so doubt it.
I believe in you, Den.
We'll see. We'll see.
But it's fine.
What's up, Sam? This one's for you, baby.
So, how's y'all's day been?
Man, it's fucking Monday, but here we is.
Here we be.
Today we'll probably kick it off like exactly at 5 because the person who requested this is here. So I feel no shame in just moving on. You hear any squeaking? It's my chair. All right, boys, it's 5 o'clock. We gonna get it started. Welcome, welcome. You guys have been here before. Y'all already know what I'm about to go into, so just bear with me. If y'all don't know, my name's Klutch. Been a technical analysis trader since 2014. I started my journey in the sewers of the OTC market. If y'all don't know what it is, I'd be happy to educate you. But it is the degen version of the NASDAQ market. Moved from OTC, kind of did a bit of small caps for a while before I kind of met crypto. Then from crypto, I got into equities, which led to options and learning commodities and futures trading. If y'all haven't figured it out by now, I pretty much trade almost specifically off technical analysis. I invest specifically on fundamentals, so there is a big difference. The technical analysis theory that I use, I love supply and demand, and I love using Elliott wave theory. The goal of these, they're going to be for educational purposes, but my goal is to educate you guys to teach y'all how to fish instead of relying on people to give you a fish. So just a quick disclaimer, I'm not a financial advisor. I do not have my Series 7, so everything here is for entertainment purposes only. This is just to educate you guys and give y'all a little bit of tips and tricks and just to kind of further your knowledge in your reach in the investment market. If y'all haven't seen these beautiful rules before, yes, I have rules. So this one, we'll just jot through it really quick. There's 10 rules I follow, whether I'm investing, trading, whatever have you. If I'm putting money in something, I like to have rules to keep my emotions in check. Capital preservation is rule number 1. You can't invest if you don't have money. So if you don't have rules and you're not, cutting when you need to, you're going to be letting your capital preserves leave without you. Always have a plan when you're getting into a trade. Whether it's an investment, whether it's a trade, I believe it's imperative that you're always going to have a plan. That means stick to your profit targets, stick to your stops, and stick to certain percentage sizes. So if you guys haven't seen, I believe it's week 2's video, we went over kind of how to have a trade plan and things like that. Number 3, treat trading like a business. Reason being is if you're, in a business mentality, in a business mindset, you're thinking logically and about the short end and long term of things. So treat trading like a business, stick to your rules, have your guidelines, follow them to a T, and don't deviate. I use chart history to identify my edge. And what I mean by that is, we're going to be using a series of technical analysis tools, whether it's bullish divergences, bearish divergences, supply and demand, Elliott wave theory, whatever have you. That's how you're going to get an edge over, the everyday trader or the everyday retail investor. Only risk what you can afford to lose. I mean, markets come and go. Sometimes the market's here and sometimes it's not. I mean, I'm sure you guys have been a part of rugs and things like that before. And if you invested more than what you afforded to lose, it's going to hurt. So make sure that you are only risking what you can afford to lose. Trade on facts. Number 6 is trade on facts, not emotion. So don't be getting all excited because you see something moving and you got to have a piece of it. What are the facts behind it? What's the data? Why are you getting into it? Not that emotional appeal. Because emotional intellect in every market is used against you, which leads perfectly into rule number 7. Be disciplined. If you're not going to be disciplined, whether it's trading, investing, anything along those lines, you're very susceptible to developing bad habits. So make sure that you're being disciplined. Your number 8, learning how to properly size. Number 9, know when you should take a step back is probably one of the most important rules. If you've ever been to a casino or anything like that and you just see yourself getting drained, I mean, that's a great spot to take a step back. If you're taking trades and you just feel like you're on a losing streak, it's probably a great opportunity to take a step back. And what I mean by taking a step back, analyze what you're doing wrong, analyze what you're doing right. You have to review what you've been doing in the past, whether it's days, weeks, months, whatever streak you're on. If you know you need to take a step back, review what's been going on. Have you been buying high and selling low? Have you been buying and not executing your profit targets and just being stuck holding a bag? Those are really important and pivotal moments for you to realize what you need to work on, whether it's trading or investing. Number 10, market's always right. Doesn't care if you thought this or thought that, or some influencer or some big, pocket person said this is, the best buy ever. Doesn't matter. The market is always right. So that's the rules. That's our disclaimer. That's our agenda. We're going to be jumping into understanding asset classes. This was a request, and this is one I'm more than happy to go over. I believe it's important to kind of understand what certain asset classes are, what they mean, how to differentiate them, and how to better understand them. And more importantly, we'll be going into a little bit about how they rotate. So if you guys haven't seen that, classic chart of how money flows into crypto and out of it, it's a good example of how to be looking at asset classes as well. Let me see if I can pull that up really quick. I'm just going to get a picture of that. And obviously, if you guys have any questions, comments, any curiosities along the way, just feel free to shoot. I will not be upset. Beautiful. All right, so there's really 5 major asset classes that are going to be in a trader's tool belt, if you will. Cash is the easy one. I mean, that's, hard cash, money you have in your savings account, just cash in general. This is just good old hard cash or fiat in crypto terms. Equity, this is going to be stocks, ETFs. If you don't know what an ETF is, we can dive into it as well. Index funds, and I mean, this one I don't really agree with, startup funding. I mean, it can be if you're in a business, but we're going to be sticking to just the things that you and I can get into and out to with ease. So equity, just think stocks and ETFs. You can think of equity mutual funds, but those are a little bit slower. Fixed income, I mean, this is really for like lenders and things like that. So fixed income is mainly going to be for us bonds. Or you set up, reoccurring deposits into savings accounts, or setting up reoccurring deposits into your IRA. So for fixed income, just really think bonds. Bonds we will be going over in a little bit more detail than usual, just because I am a loan officer, so I do understand how bonds work. Real estate is probably the most important investment every man, woman, and child should aim for. Real estate is really the key to financial freedom. If you don't own a property, it is a great time to think of how you can obtain home ownership. Whether it's going to be, a personal property, commercial property, or a rental property. I mean, any time is a great time to get a house. This isn't, to pitch you guys on getting a loan, but real estate is really the key cornerstone of setting yourself up and your family's future. Commodities. This one I'm probably going to spend a lot of time on because there's a lot of misconception of what commodities are. If you guys haven't seen what's going on with oil, well, that is a commodity. Corn, wheat, oil, copper, silver, gold, so precious metals and, everyday things that, the everyday consumer consumes. And so these are the top 5 asset classes, in my opinion, on what you should be paying attention to. Because like I said in the mailbox, there is a bull market no matter where you look. Right now, equity is kind of taking a hit. We'll just pull up this chart really quick. And so we're going to go over just a few examples here so you can kind of see what I'm talking about. Why I want this move over. Boom. All right. So, for example, this is SPY. This is the S&P 500. This is a culmination of 500 companies that are traded on the S&P. If you guys don't know what some of those are, I mean, just think, Microsoft, Google, Apple, Facebook, or AKA Meta. There's a lot of powerhouses that are held in the S&P 500. Stocks come and go off of this list. They have to meet certain requirements in order to be on here. So this is considered like the cornerstone for U.S. equities. And as you can see, just by looking at this chart, I mean, this is when COVID happened. So equities just fell at an astronomical rate, at an astronomical pace. We fell about 35.71% over the course of a month. I mean, we fell in February all the way down to about March. So just about a month, equities lost 35% of their value in a blink of an eye. But these types of markets provide amazing opportunities. So what I mean by that is if you just invest, I mean, obviously we're not going to be focusing on like the perfect low. We can even start from here from the previous highs. So it took about 636 days, my goodness, for, markets to not just break their highs, but go above and beyond them. So in just a couple years' time, we can go from the lows. I mean, the S&P 500 alone went up 118%. From the previous highs, we went up about 41%. And more often than not, no matter what year we're in, from if we're looking at 2019 to the end of 2020, we still closed at a high. The S&P 500 on average goes up about 4% every year. So it's a pretty solid standard investment because, you could just invest in SPY on its own, or you can pick apart different equity companies that are found within it. But U.S. equities are pretty much a standard for every retirement portfolio. To go into bonds a little bit. So, I mean, there's different bond yields. There's a 30-year yield, a 10-year yield. But bonds right now are kind of what's controlling interest rates. If you don't know why, I mean, U.S. bond yields are backed by mortgage-backed securities. So mortgage-backed securities are what's going to be determining interest rates. Over the past, my gosh, we'll pull up like a weekly chart here. Going to a daily. So technically, when you're buying a bond, you're borrowing it. You're borrowing the bond with the intention to pay it back at a certain yield percentage. It's really slow. Bonds are very slow yielding, very slow appreciating. So they're not super sexy. But if you're buying bonds on a 30-year yield, I mean, even though as this chart looks like it's going down, you're actually making money because you're borrowing the money here and selling it back to them here. So you're getting that negative appreciating asset returned back to you. It's a little bit like short selling.
Hold up. Hey,
question,
Clutch,
William?
am
Yo.
I the only one that does not see a chart?
Oh my gosh. Let me change this. Oh my gosh.
There we go.
Sorry, I'm on a new computer, so I mean we'll stare back a little bit just so we can kind of go over what we just went over, but I'll keep it short and sweet. Okay, so here we go. So back to SPY. This is an ETF. So this is a cornerstone for US equities, top 500 companies. We kind of went over that. But just to dive in a little bit about what we were looking at. So, I mean, this was a bear market. Granted, it was a sharp bear market. We fell about 35% over the course of just 1 month. But what I was touching on in the previous conversation without having this up, in a perfect world, if we measured it from the lows all the way up to the highs, it's very rare to see an ETF appreciate over 100% in a couple years' time. But even if we were to scratch this and just move it back to our previous highs before that bear market hit, I mean, we appreciated over 41%. So there's been rapid bull markets happening left and right. Whether it's commodities, I mean, this is US oil. This is a shocking one. There was a point where oil was below 0 cents. It was negative money. They were paying people to get oil because, the economy in the world was just shut down. Oil, if we just measured it from the highs, where we were up about 100% on gas prices from the highs in early 2020. So this is a form of commodity. I mean, if you guys hear an alien, that's just my dog. But oil is a form of commodity. Gold arguably has been, leaving a little bit to be desired. But I mean, if gold is, the old school money thinking of, diversity. But I mean, if you look at gold on like a weekly time view, like we've been setting up a beautiful cup and handle that is a bullish form. But we had our little pop here, and commodities are going to be saying little takedown here in a little bit. You can find these in different forms. I mean, this is LIT. This is a ETF for lithium. So if whatever powers your phone, your laptop, I mean, lithium is a form of commodity. It's a battery. So to kind of dive back into what we were looking at, bonds, these, if you couldn't see this chart, I mean, bonds took a huge, nasty fall for the last few years. And this is what's determining our interest rates currently. Personally, I think our interest rates are going to tap out around here before this goes back into a bit of a corrective wave. So, I think this whole interest rate hike is going to be, taking a step back in a little bit. So let's dive back into these asset classes. Let me change my camera. No, that's the right one. William, let me know. All right, can you see this one?
What am I supposed to be seeing?
Hold on. The OneNote. Is it still there? Or does it look like crap?
It looks horrible.
Hold on. There we go. So, quick summary, equity. I mean, this is going to be SPY. Fixed income, that was like the 30-year bond we kind of went over. Gold and oil was commodities. Cash, I mean, if you ever want to know what the value of the US dollar is doing, look up DXY. Just for the sake of not having to go back and forth again, DXY is how the US dollar is paired against other currencies. Fun fact, typically the euro has always outpaced the US dollar, but for the first time in 20 years, there's actually only a 1 cent spread between the two. So if that isn't a giant red flag, I don't know what to tell you. So to kind of just summarize the top 5, equity is shares. You're buying shares of companies. You're making sure you've got a balanced portfolio. I'm pretty sure I shared what my top 21 were for 2021. We can share it again. Bonds, these are going to be fixed interest rate stocks. when I was saying that you're buying them, you're planning on selling it back, it's like an IOU. The U.S. government is issuing a IOU, and when the companies want to borrow the money from investors, they pay at a fixed level of interest. So if you're buying a home, you can keep that interest rate locked for 30 years, or 15 years, or 10 years. So these are interest rates that, your bank, when you're getting your credit card, that's going to be at a fixed interest rate. So this is a form of, asset diversity. Property, whether it's commercial, whether it's a residential, this is the cornerstone for inflation fighting. So we're in an inflationary market. Inflation's up about 10% almost in the US, but on average, property values have risen over 20%. So if you have a home that's over $1 million, you gain 200,000% in equity. So if you were to sell your home, let's say you bought it, in 2020, it's up 20% now. You bought a home for $1 million, you can sell it for 1.2. And we're still in a high demand buyer's market, whether it's, affordable or not. Homes you need to look at as the cornerstone for fighting inflation, but also the major asset class for your portfolio diversification. Commodities is a huge one right now. The reason being why commodities are skyrocketing left and right is because of all of our issues that are going on with supply chain. Whether it's government created or not, we're not going to speculate. But commodities play a massive role because this isn't just US, it's global. So this affects the entire world. I'm sure you guys probably remember when we were having our huge increase in lumber during 2021. Now we're having a huge increase in oil and gas in 2022. They're typically, we're going to kind of go over this. So well, let me finish this. So commodities, this is precious silver, precious metals, whether it's gold, silver, copper, iron, whatever have you. These are going to, it says it trades just like shares and bonds because it does. Because they have a wide range of, volatility. But typically, money's going to rotate from cash to shares to property and bonds and commodities. So let's say, do I have anything here? Okay, so let's say, so this is how crypto typically rotates. You have to have fiat, your USD or your, EUR, whatever have you. It has to rotate in the Bitcoin typically in order for you to purchase, large caps, mid caps, and low caps. And all this money is going to rotate all the way down before it rotates back up to Bitcoin. Same thing can be said for, let's say cash is going to be the top one. So just to make it make sense. Oh, Lord. So typically money is going to rotate from cash to stocks. People need to have cash in order to purchase their stocks on, whatever broker you're going to have. And typically when we're in a bull market, equities are going to be going up. But in order to better hedge yourself when equities start to go down, you can rotate it into bonds, or you can rotate it into property, or you can rotate it into commodities, because these all offset each other in some way, shape, or form. If cash is going down, bonds and property and sometimes commodities can be the best place to be parking your money. So this is a bit of a balancing act. It's a bit of a dance. If, for example, property values are going down, there's a good chance that equity could be going up because money has to be constantly moving somewhere. And when I say money, I'm talking about big banks, corporations, the 1% of the world. They don't have their money just sitting idly in their bank accounts. It's being put to work in one of these 4 asset classes. 5 is cash. But typically their money is always parked in some form of asset class. So right now, the US equity is a little bit uncertain. And what I mean by uncertain is, we've had a massive rise, from the lows of 2020, we're up over 100%. If we're measuring from the highs of 2020, Equities are up over 40%. But if you start to take a look at the underlying, meaning of what's going on, there's a giant separation in the markets. Meaning, let me actually pull up another chart just so that we can be looking at some visuals. Give me one sec. Okay. So let's take a look at some examples. So this is my equity chart. Yeah, we'll keep it on a weekly. So I mean, this is what's going on with the S&P. I'm just looking at it in a different index. This is SPX. But if you're taking a look at this, I mean, we had our highs and we're down about 20% right now. We saw a low of 24%. But if we're taking a look at some of these other bigger companies, Microsoft is tied into SPY, Apple's tied into SPY, it's seen a 28% decrease. But if you start kind of going outside of it, I mean, granted, Tesla's new, they just joined the S&P and they're down about 43% from their highs. So I'm trying to paint a picture that US equities is currently in a giant downturn. Oops. So, I mean, Twitter, even from its highs, I mean, we saw a low as 60%. We're currently down 59. I'm not going to go over the meme stocks. Verizon. I mean, all these things have sectors. But if we're taking a look at gold, gold from its highs is only down about 16%. So it's still down in the grand scheme of things, but it's not as bad as some of these US equities. Like this is Netflix. Granted, they had an astronomical situation, but this company was on a strong upward trajectory for years. And we just gave it all back in the blink of an eye. Netflix is down over 74%. And this just happened like this year. Like this is November was its highs. December, it kind of had a little pop, and then January, just a giant flush. Granted, it was an anomaly. It was their earnings reports. Didn't do great. NBC, this is an oil company. So, and keep in mind, this is on a weekly time frame. But the picture, mother, that's my dog. NBC, it's down about 26%. It's an oil company. It's Marathon Petroleum. But when we're taking a look at how it's holding up against something like Home Depot, they hold a lot of commodities. They're going to be holding a lot of, lumber, things along those lines. It's still down 31%. But you look at some of these super stable companies like Coca-Cola. This company from its highs is only down 5%, 6%. And at the lowest it saw was 13%. So there's different asset classes. There's even different classes within, different sectors. Some of these bedrocks that don't move that much, but pay you handsomely in dividends, like Coca-Cola is a great company for dividends. Every quarter, they're paying you about 44 cents gross on each share you're holding. So this is a different form of asset class within the S&P 500. This isn't a growth stock. Growth stocks are going to be the ones that are like Tesla, where it's speculative, but almost all the money made on it is going to be on the growth of the company and how well it does. But a high yield company like Coca-Cola, it's high yield because of the dividends that you're going to be receiving as a shareholder for holding their stock. I mean, there's plenty of companies out there where you can diversify your portfolio and still somewhat be in a relatively safe and slow moving stock. Exxon, I mean, this is Exxon Mobil. From its highs, it's up down 18%. It's not as bad as some of the other ones. I mean, Adobe, this is a tech company. There's some out here that are painting you a gruesome picture where it's down 45%. Target, this is going to be a nasty one. This one is consumer discretionary. For those of you who are across seas, maybe you don't have Target, but this is like a Walmart for us. It's down 45%. So you can see that consumer discretionary is down, and so is tech. So money is rotating in different asset classes. GE, same thing. It's a consumer discretionary product. Like these things had their massive lows in 2020, but on the rise of 2021, consumer spending was up and inflation was up. So the market that we are currently in is an anomaly, meaning that this was like a once in a lifetime kind of event where things just fall 35% overnight, or not overnight, but they're falling 35% over a month. And over the next couple of years, things are just sky high. So what I mean by, money is constantly rotating. Money's not just going to be sitting in one asset class. Smart money is going to be taking advantage of these extreme lows in the market and loading the boat down here. And they'll even manipulate it a little bit to where if they can hold it down as long as they can to trick people to kind of keep loading up their cheap shares, they absolutely will. But I guess what I was trying to say is if right now U.S. equities are a bit uncertain. There's not a whole lot of certainty that this is the bottom for the S&P or if it's going to continue higher in the short-term intermediate market. So you might be asking yourself, where could I possibly be parking my money? Well, as of right now, if you're taking a look at this chart, this is the U.S. 30-year yield. This has been on a consistent upward stair-stepping trajectory. So bonds right now are typically the safe haven. But if we're seeing what's going on with commodities, let me see if I can actually pull up a screener. Sorry, I typically go off of a different format for this, so give me a sec. If anyone's got any questions, go ahead and shoot. Come on. No. Okay. All right, I'll have to pull it up in a bit. But for example, so we're going to go back and compare SPY to how it's been doing since December to where we are currently. So since December, we are down roughly 20% in the current market. But if we're looking at the bond yields, we're going to be looking from December on up until where we currently are today. Bonds are up over 89%. There's always a bull market somewhere. And so if we're taking a look at the difference between these two, we're talking 20% versus a 80% appreciation. So if you were in the market for lending money, your current interest rate is going to be up 90% in comparison to where it was in December. If we're looking at U.S. oil, this is December. We're going to be going from the low to the current market. We're up 64%. So money currently right now is rotating out of equities and into the safe havens like bonds and commodities. If we were to take a look at, I know there's a stock for the U.S. market. Is it RET? I don't think it is. Give me one sec. Let's see if we can just pull it up. No. That's going to be deals. Sorry, guys. Probably should have had this one ready. But MBA purchase applications. No. Sick. So we're going to have to go up with this guy. But if we're measuring it from December, this is what a 5% increase would have been, and here we are in 2022 for 20%. So let's split the difference and say it's up 15%. So while currently the U.S. equity market is down 19% over the last year, home prices are up. We'll just split the difference at 15%. So money is always going to be rotating somewhere. So if the housing market is down, typically the U.S. equities, SPY, and all of the little lovely ones that follow underneath it are going to be the first ones to start rotating. If they're down, typically you can look for bonds to start being able to purchase them and get that form of an IOU and get it back to, the governments that you're going to be paying it back to. There are ETFs for oil. You can buy oil ETFs. You can buy gold ETFs, or you can just house the actual physical currency. I mean, granted, gold isn't the sexiest over the last few years, but if we take a look at crypto, I mean, crypto is kind of the bloodbath of all right now. I was kind of saving it for last. I mean, this is going to have major, major highs and lows. Right now, crypto is down just about 71% from its highs here. So crypto was the first to go. As you can see, the date on here is November 8th. So crypto has kind of becoming a leading indicator of where retail is going to be putting their money. Retail is you and I. If we're taking a look at when SPY started the turn, that is back in January 3rd. So there's indicators that you can kind of look at by these different asset classes. I mean, crypto is kind of in an asset class of its own. It's digital currency. It's not a top 5 yet because, there's still a lot of speculation around it. But if you were to look at the flip side of crypto, I mean, this is 2020. We're using those measurements to figure out what that appreciation was from the extremes. I mean, crypto was up over fucking 1,500%. So this is an incredibly volatile, speculative market, but it still has tons of room for, upsides that are, astronomical in a sense. Like, you're not going to find this in all of these other markets. These are the safer markets. The equity market, housing market, ETFs especially, bonds, all of those are going to be the safe havens. While crypto is going to be that speculative market, but still has an incredibly high chance for a positive return. It just depends on what your plan and your strategy was for crypto. So I think I had one more thing to go over. And so these are the different bond yields. I mean, this is short-term money. Like, if you were to buy a car, you're going to be looking at a 3-year or a 5-year yield. And you can see that this chart's just on an upward trajectory. So if you were to buy a car right now, it's probably the worst time to buy a car because the interest rate on that car is going to be, let's take a look. If you were to buy it in 2021 from this last pivot, I mean, you're going to be paying about 395% higher than you normally would. Obviously, that number sounds extreme. You wouldn't really be. I mean, we're talking about an interest rate from, it would cost you about 2% to borrow for a 5 years, but now you're paying more around 6. So that's how those percentages work. So even though it says 395%, you're paying about 2.43% higher on your interest rate than you would have over a year ago. So you're seeing these things stall. This is what's going to be the biggest indicator of, where the housing and, the fixed income borrowing is going to be going over the next term. So we're waiting for this to cap out. Right now, I'd say the leading indicator is actually going to be the bonds. So all of the speculation that's going on with the S&P, why people are a little unnerved, same thing with the housing market. People can't buy houses right now because interest rates have gone up so fast over such a short period of time. I mean, we're talking just 6 months ago, we were at 87% lower in terms of interest rates than we currently are today. So someone who was going to buy a house for for let's just say 1 million, well, we're up 20%. So that house is now 1.2 million. And to tap it on top of it, the interest rate is now 80% higher than it would have been a year ago as well. So you're seeing that there was a huge demand to buy because there was so little supply available. This goes back to supply and demand. If there's low supply and high demand, we're going to see squeezes. This type of squeeze, though, is to offset inflation, which is a stupid metric using, interest rates to curb inflation. Right now, they're trying to have interest rates be higher than the current rate of inflation so that consumer spending can get back down to normal. This is a huge indicator of where we are at. This is if we were to take the 10-year yield, which is this, and the 2-year yield. This is typically where we have signs of recession. If we have a negative bond yield inversion. What do I mean by that? That it is more expensive to borrow short-term money. So the 2-year is 3.06. The 10-year is 2.987. You see how that's backwards? Typically it goes 3.06, 3.09, 3.04, we're going backwards, 3.064, still going backwards, 2.98, extremely backwards, 30-year, 3.17. All of these numbers are supposed to be higher than the previous ones. Why? Because there's supposed to be more safety in borrowing money in the long term versus the short term. The fact that short-term money is more expensive to borrow than long-term money should be a giant red flag of how safe and secure the bond market feels. So this, whenever people are talking about signs of recession, they're looking at this chart. They're looking at the bond yield inversion. I mean, back in 2019, this was leading up to COVID. In 2020, we had our recession. Granted, we probably never got out of it because we kept printing money and causing these yields to go up astronomically. But if we're taking a look back in 2007, we had a sign about 2 years ago that the housing market was going to be in trouble, and it just kept getting ignored. And then we kept printing those awful bonds that, we were borrowing, we were giving out, we were letting people borrow money without properly doing the checks and balances to see if they actually qualified. So bond yield inversions are a major indicator to be paying attention to. And so this is what the people on Wall Street, the people who know about markets are looking at. And right now we're going through a negative bond yield inversion, which is incredibly bearish. So if you're asking places where the best place to put your money is, I mean, we were just going through a major inflationary market. Granted, we still are. And the best place to be putting your money in these types of markets, I mean, personally, when I invest with the intention of holding these for years. So instead of just selling my stocks at the top, I sell credit spreads, or I start slowly dipping my money into, this is going to look awful, but in case you didn't see what happened in 2020, this is UVXY. So this is it's an ETF that inverses the S&P 500. So in 2020, we were all the way down here. But a ETF like UVXY, I mean, granted, this is an astronomical squeeze, but we went up over freaking 1,100%. You can look at VIX, same thing. This is a volatility index. We went all the way down here to about a 500% pop in a month. So there's a few things you can kind of do. Does someone have a question or somebody on? Okay. But there's inversion charts, or there's inversion ETFs that you can just put a small hedge into, where you want to be keeping at least 20% cash set aside at all times to be taking advantage of these turning points in the market. Instead of buying here and just selling up here, you can buy and hold, and then just sell credit spreads at the top with your remaining 20% capital. Each time we have these pops, you could sell calls, you can sell calls, you could sell puts, you could sell puts. We might do a class on selling credit spreads, because I think selling credit spreads while holding your portfolio is a major advantage. Because if this was the first time I got into the market and I was to sell up here, I mean, I have to pay taxes on that. There's a whole lot of implications that come with selling your portfolio. But if you were to look back, we might have to go to a monthly chart. Oh my God. Bear with me, new computer. So this was 2008 to 2009. Looks a little similar to 2020, right? And if we were to have that opportunity to buy down here again, sorry, I gotta like really zoom out. If you were to buy it from the low in 2020, I mean, you're up over 500% if you were just to buy and hold your stocks and companies that you truly believe in over the long term. And if you were to just sell them at the first bump, I mean, granted, you'd be having, they were up about 100% here. So, I mean, if you were to buy and just sell them, you're going to be paying taxes on that. Let's say you do get 100% return. You got at the bottom perfectly, you got out the bottom perfectly. You're giving up about not only you're going to pay taxes on this. Let's just say you're in a state where you have income tax and you have state tax. You have to pay double taxes on this, and you have to pay capital gains. You're just cutting your investment completely in half. But if you're holding your money in a IRA, you don't have to pay taxes on those items, and you could recoup your investment at the age of 55. But the best strategy is really to just buy and hold over the long term, because this is this is where wealth is created by buying and holding shares of companies that you truly believe in. You can just take a shortcut and buy SPY. I mean, SPY actually pays you dividends to buy and hold its ETF. So if you're not sure what stocks to buy, you can just buy SPY. Again, it's not financial advice. I'm not a financial advisor. But I mean, I've been buying and holding shares of just the S&P SPY since 2016. And I mean, if we're all the way back here in 2016, like, I don't remember exactly what month I got in, but I loaded my IRA that I made as a kid and put all the money I made as a kid into the stock market. And I'm still holding it because there's no point in me selling it. Because if we've learned anything from markets, they go up, they go down. But ultimately, I mean, the markets just continue to rise year over year. If we're taking a look at bonds, I mean, we're borrowing money with the intention of selling it back. It's going down year over year. So your IOU is getting more money back for you. If we're looking at gold, this is a monthly chart. Granted, if you got in here, you're really pissed off because you had to go through an entire bear market since 2011 up until 2020. So gold over 9 years did not appreciate that well from its previous highs. I mean, we're talking 8%. But gold is still stable in a sense. I mean, it's just not going to be as sexy as SPY. So, I mean, I'm not, advocating to buy gold, but gold's a bit more stable than Bitcoin, if you will. But for the crypto market, I mean, this is why we're all here. Oh, God, let's change that. So, I mean, crypto, in my opinion, because I always like to wrap these up kind of going over crypto, we're at a pretty pivotal point where it's time to start paying attention to what's going on in the crypto market. If you kind of read, well, before I go into this, I mean, I know I went over a lot. I'm going to put in some educational material for you guys to read, but did anyone have any questions over anything that I just went over for the last 40 minutes?
I do have a question.
Sam, hit me.
Yo. I was wondering if you knew of any kind of exchange where we could trade commodities, buy, sell in a somewhat easy manner, or
I mean, typically if you're trading commodities and not just going off of the ETFs, you can use a lot of Forex exchanges. I mean, I've used MetaTrader for a while. Like if I'm buying and selling futures or anything like that, you can go off of Forex exchanges. So if I haven't traded Forex in a long time, and the brokers are always changing because some are getting liquidated faster than others, but you would be trading Forex. You can buy gold physically, or you can buy gold ETFs. So this is gold futures. So you can be buying futures, but you have to literally have $1,731 to buy one share.
Right.
Or you can buy the option contracts of gold. You can buy option contracts of oil. I mean, my personal preference, instead of buying just the ETF or the commodity itself, you can research companies that are mining gold, companies that are mining wheat, companies that are mining copper, because those ones are going to be the ones who benefit better for you versus buying the ETF itself, because that company's going to be making money off of the appreciation of the asset that they're in business of. So so gold, we can do some write-ups and find some gold companies. We can do some write-ups and find oil companies. I mean, oil and gas companies are pretty easy. I mean, MBC is a gas company. Exxon is a gas company. So instead of buying the ETFs, you could just buy shares of the company. And in a bear market where commodities are doing well, but equities aren't, oil is going to be the companies that are going to be doing well versus, the companies that are buying and selling tech and items like that.
Right.
So instead of buying the commodities, look into companies, because those gold, oil, copper, silver, lithium companies, they're going to be doing better than the actual ETF. This is an ETF, so this is LIT. This is a global lithium battery tech ETF. So this is, the leading indicator for what lithium companies are doing. But you could also summarize lithium as Tesla, technically, because they're buying, selling batteries. They're in solar. They're in clean, green energy tech. But this is a highly speculative one because, it's got Elon at the helm. But, never fade Elon.
Okay, awesome. Yeah, thanks. I'll look into that much more then.
You could go on, like, I believe, stock charts can give you a lot of, okay, no, I'm not going to leave. But, stock charts, they can give you a whole lot of tools, and you can break down exactly what companies are in those. Same thing with FinViz. I love FinViz. It's just a financial visualization is what it is. And so, for example, this whole thing is the S&P 500. It's broken down into different sectors. You have the tech sector, you have the financial sector, you got communications, you have healthcare, industrial, real estate, energy, utilities, consumer. This is finance, so this is banks. Wait, no, it's not. This is, I forget. It's not labeled right in my mind because this is consumer discretionary. So like things that we're buying, like McDonald's, Amazon, Nike, Tesla, things that we're buying every day. I'm drawing a blank and it's pissing me off. No. I'll figure out the name. Defense? No. It's labeled something else in my mind, but you know what I mean? And the larger the box, the bigger the market cap. So you could just look at, Microsoft and Apple. Actually, Apple is the largest company that is a tech company. For financial, it's probably going to be Berkshire. I mean, Berkshire has its hands in everything. Like, Berkshire is Warren Buffett's company, and he has his hands in everything. Everything you can think of. Verizon is another large one. Same thing with JPM. Same thing with MasterCard. The leading communication company is Google. No shit, it's Google. Healthcare, it's Johnson & Johnson. I mean, you look at half of your healthcare products, your shampoo, your soap, it's probably going to be a Johnson & Johnson product. Amazon is the biggest consumer discretionary. No shit, they own everything. But understanding the sectors and looking at these boxes and figuring out who's the largest market cap is typically going to be the safest place to park that money. I mean, if you don't own shares of Walmart or Costco, I don't know what to tell you. Like, those guys are by far like one of the best investments I've ever gotten into. So let's
Would you
just
still say it's a good investment?
me personally, because I'm very skeptical of the current market. I mean, right now, I keep 20% set aside in cash, but I'm actually building a larger reserve to be set aside to, let me just look up cost. So this is Costco. I mean, it did take its dip. It depends on what your investment plan is, though. From the highs, Costco fell about 30%, but it's bounced back. We're going to do a little flip. Costco's also bounced back 23% from the lows. But you're going to see a whole bunch of jargon of when I was getting into Costco. But if we're looking at Costco during that fall in 2020, I mean, it did fall, yes. Let's get the auto. But it also stayed far more. It was chopping like crazy, granted, but it was having big swings and big swing highs, large swing lows, back and forth. But ultimately, it was still a relatively stable chart. And then when finally the world reopened, Costco just started cranking. These are on a daily time frame. Costco kept going and going and going and going. Like, Costco is a fucking beast. Pardon my French. But I'll do an Elliott wave count on this, but ultimately, I mean, Costco could completely separate itself because even though it's part of the S&P, it's also part of Nasdaq, and Nasdaq has a top 100 list. It's called the Nasdaq 100. These are the cream of the crop. These are the blue chips. Anything that's not in the Nasdaq 100 is not a blue chip. Blue chip is Nasdaq.
Okay. So invest in the company and not the commodity itself.
Yes, but you're investing in the commodity, but you're just
Yeah.
investing in the company that's mainly driven
Indirectly.
by exactly. Because it's easier, it's cheaper, and more often than not, they'll pay dividends, and then you can be collecting some passive income off of it as well.
Cool.
Sir, does anyone else have any questions? You got another one, Sam. Feel free to ask.
I was hearing this thing of some people were calling Bitcoin a commodity. What are your thoughts on that?
Fucking peasants. No. I mean, it's a digital asset. It's not a commodity. It is. I don't know who would call Bitcoin a commodity. I mean, it's a currency. It's not a commodity. I mean, it might be precious in a sense, but it's not gas, it's not oil, it's not wheat, it's not copper, it's not iron. We don't physically use this. Commodities are physical assets. This isn't a physical asset.
I see. Yeah. Okay. Just wanted to clarify that they were stupid.
Yeah, they dumb, but it's okay. All right. So we got. Oh, I'll go a little bit over. But we like to summarize kind of week over week what crypto's been doing. And so, if you guys kind of saw my write up, 23. Well, let's call it 23,000. I mean, in order for me to be bullish on Bitcoin as a whole, we need to be doing. I'm just going to use this count because it's clear. Like, we put in a swing here, but in order for this to be a bullish cycle, we need to break this high. If we were to break this high, we can confirm we're in an impulsive wave, but we're not there yet. Like, this high is lower than this high. This low is higher, but then we had a lower low. So I'm talking about these swings. So this is a swing low. This is a swing high. This is a swing high. This is a swing low. And what you want to be seeing to get some confirmation from, buyers is you want to be seeing this beautiful staircase step going up. That's an impulsive wave. That's a sign that buyers are in control and sellers are not. Sellers are taking short-term advantage of lower swings, and bulls are positioning them higher than the previous swing. So you want to see those staircases going up. When it's consolidating like this, I mean, price is in agreement. And if we've learned anything from our first lesson, after a phase of price being in agreement, just like it was here, there's an imbalance that follows afterwards. This case, it was a bearish imbalance. Sellers exceeded buyers at an astronomical rate, and we have an imbalance. This is the larger imbalance on the chart. I think I drew this on a daily or a weekly time frame. And the reason why I drew it here is because when we retested this zone, we faded again. There was a balance between buyers and sellers overpowered buyers. The zone starts here because this is where we tagged the zone and rejected, confirming that there is a high increase of selling pressure happening here. And we saw that again here because we've tagged this zone and rejected, came close to the zone and rejected. This is telling you that there is a strong imbalance here that we couldn't even get up to the zone, that sellers are still overwhelming buyers. And if you look at volume's your best leading indicator. Volume's in a complete downtrend. We have these little pops, but it is nowhere near where it needs to be to reverse this. There has to be an overwhelming, like this volume chart right here. I mean, this specific candle, there was, where is it? About 81,000 Bitcoins sold and traded in one given day. And you have a massive range in this candle. I mean, just this candle alone with 81,000 volume, this is just Coinbase, by the way. This isn't a Bitcoin futures. We fell 20% on a 81K volume day on just one broker. So when you're typing in things like BTC USD, I mean, look to the right, because this is going to tell you that this is Coinbase, this is Bitstamp, this is, Bybit, this is, what is that, FTX? No, that's FTX. Bit, whatever. Binance, Kraken, Gemini, all of these are brokers. I just used Coinbase because it was the most liquid, but arguably it's probably not the most liquid because they might be going bankrupt. And Binance is probably the most liquid broker out there. So when you guys are buying and selling crypto, don't keep them on exchanges. I highly recommend keeping your crypto investment stored in a cold storage device, meaning it is on a ledger where it's not held on a large central exchange. Because if that central exchange goes belly up, like KuCoin did recently, they can freeze your assets and stop you from withdrawing it because they need liquidity to, free up their own assets. So they could just freeze your assets one day and you're not able to buy or sell or get your money off that exchange. So never keep your money on central exchanges because you can never know what can happen. So right now, just to summarize Bitcoin, when I was doing my write-up on Sunday, we were trading high and tight, meaning after a pop, we were consolidating, we were staircasing down. The highs were lower and lower each time, and the lows, this is where you kind of get these like bullish formations where price is starting to pinch, meaning they can be trading in this range, but typically when they get to these extremes on these trend lines, something's going to give. And here, the support gave out quickly. And when it gave quickly, it just started a massive downtrend. And we did put in a higher high from the previous one, but it wasn't high enough. We needed to break this zone. We needed to get up to this zone, and we didn't. And so now we're seeing a downtrend because buyers weren't willing to step up to the plate and over exceed sellers. And this is what's causing, all of these guys to fall. We've only been open for an hour on this daily, and this is what's following suit. Before the close, I think we were down like 8% on the day on some of these. So we're still in a deep corrective wave for crypto as a whole. And if we're taking a look at Sol, Sol's no different. Oh, fuck. Sorry. Did we close? Oh, no. So whenever we're closing below these fibs on a daily time frame, it's not good. So I'm measuring, I'll just delete this box because it's no longer viable. I was measuring from the bottom of this wick to the top of this wick to the left. And when you load out all of your fibs, this is a measured move for some of you guys who are studying Elliott Wave. These are retracement zones. And so when we tagged 50%, we saw a little bounce. We faded to 61, we whipped a little bit, but when we lost it, there was some turbulence because when we lose the golden ratio, it's going to spell trouble. We're going to be diving down to the 78%, getting a little bounce. But when we broke it hard because that's usually the last line of defense. And so if we're going to retrace below 100%, we're probably going to lose the swing low of here and probably here. Like, we're probably going to a deeper retracement around, watch what happens around 123. It's 31.48. 161% retracements around 28.93. But the fact that we couldn't break this supply zone makes me think we're heading to a much, much deeper demand zone. Because if buyers weren't willing to step up here, they're going to be scared to step in here, and they're probably going to be targeting down here. That's just the picture that, we were kind of painting on Sunday. If we couldn't hold some of these levels, that we could expect a much, much deeper retracement. And the fact that we broke 88.6%, that's like the last line of defense. If we break and hold below that, like, we're losing 100 for sure, and we're probably testing 123 or 161.8%.
Well,
so if you don't know what I'm talking about, when I'm talking about these fibs, go study Elliott Wave. I'm telling you, it's going to give you a huge edge in the market.
Now what if, let's say, this green candle just really starts moving and it holds that area like above that percentage you have right there, the golden ratio one. Would
So I bet that we. Oh, come on. That's where we reverse the retracements. So we're drawing from the peak of this measured move down to this measured move, because this is where we're currently holding, right? Like this would be a measured move. So you could probably expect that to pop to 23.6. But if we break 38, which I kind of doubt because this is a new little insignificant supply zone, like I bet we could bounce the 38.2% before we start heading back down. Because if we look at, these moves, this would be a move down. We could pivot back and create a new leg going up, creating a lower high before breaking back down and making a new lower low. So when I was saying don't get excited on these bounces, that's what I was referring to. Because we could barely get above 61.8% here on this pop. And this was measured. Oh, I don't want to delete it. So this was measured from the high all the way over here to the left. Here, I'll just start putting these on here. Trend line. So this 61.8% was measured from the top of this measured move to the bottom of this leg down here. You could have went lower, but typically this corrective wave probably actually corrected itself here. Like this is where that swing would have pivoted because this measured move was complete on this last low, that this is the new leg.
Okay.
We might do a class on Elliott wave. We might, but it's like a week. It would be like a long fucking class.
This isn't really TA, but
oh, this is it. Oh, your question. Sorry.
So have you ever looked at the moon cycle chart compared to crypto?
Yeah, I've got a buddy who follows astrology really, really well.
Astrology
and
TA.
it's I don't know how the fudge it plays into an account, but I've seen it work and it boggles my mind.
Yeah,
But
I made a chart once and I was like, okay, let me see if this is actually true. And then like I looked it up and all the dates corresponded to a pump. And even like if it dumps after, like there is that initial pump that leads up to the full moon. So that's why I was like seeing this. I'm like, well, what if, the full moon comes, we got what, 2 days? Usually it lasts for like another 2 days. That's what I was thinking, like here probably would. I mean, before it does kind of dump on us.
Bulls are trying to hold this swing low. And I mean, for good reason, because if we lose this, we're losing a swing low. And if we make a new swing low, this whole thing's going to get lost. Yeah. And we just opened a new day. So I know Europe's going to open in like 4 hours. And, once they see this is down, they're probably going to buy into it. And then by the time their cycle's done, the U.S. market's going to open. And that could be that move that leads up to the 50%. Or the 38.2%. But personally, like I think, if we're able to hold this base, we're going to pop to here, here, or here. I don't think we're going to get to here, but we can. And if we do, we're definitely going to turn this ship back around and just flush. Because if we know anything about impulse waves, they move up in 1, 2, 3, 4, 5. And corrective waves move down in counts of 3. So if this was a corrective wave, we have A, we have B, and then we have C. And if you look at Bitcoin, oh wait, no, I had it on here. Mappy, where'd you go? Did I have it here? Let me get my bearings. Oh yeah, it was on Bitcoin. My bad. Bitcoin. Oh no. Control Z. Thank you. Bitcoin, we're in a large ABC correction. And we kind of had this weird imbalance here where the count became an ABCDE count. Meaning we were bouncing in a bear flag until price broke that bear flag. And so that was the move down to A. This was the move up to B, finishing this cycle. And now we are in a sharper correction to C. And, you know, the beginning of this move was measured at the bottom of wave 2 over here. And so the market moves in cycles. 1, 2, 3, 4, 5. We had our 1, 2, 3, 4, 5. 5 has to break 3. But when we break below 4, like we did here, which is why this line was red, if we broke 4, like, I mean, it was going to be an Armageddon light show. And we're seeing it now. I mean, just from that level, you know, we are down 30%. We saw a low of like 38. And I mean, it doesn't look like much in the grand scheme of the chart, but losing 38% in 1-2 weeks is pretty extreme if you ask me. So to, I guess, answer your question is I don't see Sol's measured move being complete. You know, we could be in a much larger corrective wave, like a B, C, D, E count. But in order for that to be done, this leg has to finish, and it has to finish like fast, because that's just how those corrective waves work. It's just how I've seen it over the years.
Gotcha. And then I had one more question, just briefly. So I saw this on Soul Sniper. They tweeted this the other day, and you know me, I'm very bullish on Just Apes as well. And they posted these two together, and they were like, "Would it be?" They were like, "What would this be trippy if this happened for Just Ape? Charts are fun." But I posted it.
Just Ape?
I posted it in your Klutch Trading channel.
Okay. Oh, Wyckoff, or sorry, Wyckoff. Yeah, Wyckoff is. I mean, if you look at Fudge, if you look at, so if you guys go to a, hold on, let me actually just pull it up. How do you spell it? Oh my God.
Wyckoff.
So this is fascinating. So, I mean, I've seen Wyckoff work beautifully in Bitcoin. So if you, I had a buddy who literally did this specifically for Bitcoin, and it followed it to a T. Let's pull it up and see if we can get it matched up. Okay, so this is Bitcoin, and this is Wyckoff distribution. You know, we had our giant phase A crank, and then we kind of had these imbalances. Like there's these resistance and support lines. But if you look at Bitcoin, I mean, we had that distribution phase, and when we finally broke the lows of it, the distribution phase is, that's my dog. Like this was kind of our bear flag, if you will. And then when we broke, we just completely flushed down. Like that was that distribution phase coming into fruition for phase E. And I wouldn't be surprised if this was our low in Bitcoin. That was the pop we're seeing. And then we're going to just finish our flush with phase E. But to kind of touch base on your accumulation model for Just Ape.
Yeah, that's schematic number 2.
I mean, it's tough for me to say that, you know, NFTs being a micro market can follow these global metrics. I mean, if you look at the daily, so what, they're looking at it on a 4-hour. I mean, Wyckoff method or not, this is accumulation. I mean, it's trading in ranges, but it's holding itself incredibly well. I mean, Just Ape, I mean, I'm like just looking at the chart, I'm bullish. I mean, we could get rid of these dumbass support and resistance lines, but just the fact that it's holding itself and popping itself at like each of these little demand zones is telling. Like there is demand at the price point, and it's not going to dip below 5 for very long. Like each time it gets in this 5 zone or like below, we pop up and we stabilize because buyers are willing to buy it at that price point. Sorry, I gotta close my door.
You're good.
Mama came home and the dog is super pumped about it. But I mean, yeah, I mean to kind of like look at your model. I mean, I can't say whether or not Wyckoff actually would be able to be utilized in a NFT format. I think the market cap's just too small, but people could be looking at it and playing off of it. So I mean, it's all based on what like social sentiment and like retail is looking at collectively. I think very few people in the NFT space even know Wyckoff even exists. Even if they have large sums of money, I doubt they have like the manipulative power to move it like that. But
Right.
this is accumulation, whether you're looking at that accumulation schematic or not. Like this is just it's holding itself, and people are accumulating it. Listings are slowly going down. From when we first dipped, we were at 16, and now we're all the way down to like 900. It's almost a 50% haircut just on listings alone. So people aren't buying it and then immediately listing it. People are buying and holding. So you can just look at accumulation just on the listings alone. Like whomever is buying it on these pops, they're not all relisting it, they're holding it. So this is being accumulated. You can just look at the listings too. Like that's
Yeah.
just going to tell you a real prettier picture.
Yeah, my target, double digits, and then I'll probably get out and hold my forever one. But I've accumulated as well with whoever's accumulating too in this zone. So
You know what? This Just Ape is your call, and if it rips, I will retweet and blast you and pin you for ages to come.
it's when you have the conviction.
Yeah.
There's few projects that I have conviction in.
I mean,
And honestly,
do you know much DD behind it? Like what due diligence made you bullish on Just Ape?
Oh, it's just apes.
You gotta give me more than that,
No,
man.
so they regardless, like they started off with a lot of FUD, and I'm not gonna lie, I even FUDded them. I made some memes on Twitter about them. I made a funny Curious George book, and I was like,
That's
I'm like,
kind of cute because
yeah,
it fits it beautifully.
yeah, and then I made fun of them, and then after I saw them and like saw the team and their announcements and the shit they're doing and like the partners they have, I mean, they gave away 2 tickets to Tomorrowland and flew the people out for it. I mean, they have
That's sick.
yeah,
That's not cheap.
that's not cheap. And they have like
That is not
they
cheap.
have a meetup that they're doing out there with the 2 people that won it. They have a partnership with Diesel. They have a lot of connections in the space between ETH and Sol.
Diesel? Do you mean Shaq?
No, like the clothing brand Diesel.
Okay.
So they have a thing where like they have this like trade of the month, and like last week was the hoodie hoodeds, and everybody that had a hoodie hooded is gonna get sent like a Just Ape hoodie, and then they've already shipped out their hats. So I mean, like a lot of these people, like they say they have merch and stuff like this coming, and it's like that shit never comes, and they've been delivering, since day one. They have their airdrop. They have like a staking thing coming too. And they
Have you looked into their treasury? Like, do you know how financially viable they are as a product?
I mean, they had 10,000 mint for 5 Sol when Sol was pretty decent. So
Do some digging into their wallets.
to,
That's my recommendation. Because how I look for financially viable projects, I dig through their wallets. I want to see where the mint money went, where the distribution of stuff, like, because, sometimes they'll post on SoulScan, like, hey, we just airdropped this person, this amount of Soul. Follow it, see where it came from. Like, it might be coming from a member, or it could be coming from the treasury itself. But that's going to tell you how financially viable the product is.
Okay.
Because I want projects in this market who are being smart with their money. We're in a bear market.
Well,
so
speaking of bears, that's also why like one thing I'm bullish on is bears. Like my goal is to either sell all my Just Apes and buy a bear, or buy another cat on crack.
I mean, and a lot of these will post their market cap, meaning how many people have bought and held those bears. So bears is at a 980,000 Sol market cap. That is absolutely insane. if you look on Magic Eden and just look at their like 24-hour volume or their all-time volume,
Bro, it's 10%.
this number
It's 10%.
damn near almost surpasses it.
Yeah, they gave Magic Eden 10%, I believe, their total volume.
This
This
is
one
like,
project.
this is a massive project. I mean, you could argue that, I still can't believe it was like down here at one point. Like that angers my soul.
I know.
But look at the listings. People aren't letting this go. Like we're
No.
down to 769 listings out of 10,000. There's right around actually 7.69% is available on the OS, the outstanding shares. So that's the outstanding shares that can be bought and sold on the market versus the SS. SS stands for share structure. So you want to look at the OS versus the SS because that's showing you demand. So if there's only 7.69% available to be bought and sold, that means the other remaining, we're just going to call it, let's just say 92%. Sure, we're going to round up. There's 92% of OK Bears is being held. That is just bullish sentiment itself, and that's how you create this structure here. We're at a 98 soul floor, and almost I don't feel like doing math right now, but you know what I'm saying.
Yeah, exactly.
There's this. Oh, here it is. This is OS versus SS right here. 768 OS / 10K SS. Definitely educate yourselves on the difference of OS and SS, and it's going to help you understand the supply structure within any given project, market, stock, whatever have you. Because that's bullish. Like if you see NFT projects that have over 10% listings, you'll see that they're, this is going to be going down. But if you see that number's below 10%, that means over 90% of the people that are holding that project are holding it. And that's bullish enough to get in, But you want to make sure that they're a builder, that they're being smart with their finances, that they have liquidity in their treasury, that they're not just going to go belly up and rug their project. Because when a project goes bankrupt, they need to get their exit liquidity, and that's just rugging the project.
Yeah, and that's one thing that a lot of people fudded them for was right after their mint, they turned their whole treasury to USD.
Which is so smart. I mean, It totally screws the SOL market, but it makes that project more financially viable.
Exactly.
And I guarantee you, the second that the bear market's over, they're going to rotate that back into SOL, and they're just going to be creating crazy interest and intrinsic value just on their investment as like through their treasury alone.
Yeah. So,
Good examples, Dan.
Yeah, that's why I'm bullish on, either trying to get a bear or another cat, because I don't know if I'll be able to get a bear. Because I would have to dump almost everything that I have just to get a bear, but I would be able to dump half my stuff and be able to get a cat, which I think, just looking at the market and the
similar structure. I mean, 289 OS versus 6969 SS. We are listed below 10% dramatically. Let me get my calculator.
Where's my TIX 8000?
So there is only 4% available shares to be bought and sold for Cats on Crack.
Yeah, that's why.
That is super bullish, and that's why the floor is able to maintain such an accumulative looking range, because people aren't willing to sell their investment. That's bullish. If there was like a NASDAQ 100 for NFTs, Cats on Crack would be on there, Bears would be on there, for sure.
Oh, exactly. And that's why, I don't know, I just feel like a lot of this just pump and dumps, you see in the space. It's just, I don't know, I just feel like it's kind of irrelevant. I really don't want to play into them too much anymore. It's just I want to keep my cardboards.
No.
I have my cat already. I really want to try to get a bear and flip my Just Apes and keep my 1/8. And then I think that'll just be my bags. And then,
I mean, if you look at cardboard, there's 10% listed. But if you look at the daily view, I mean, we've just been holding this accumulation range forever. Yeah. I mean, if you look at the listings, like here, we were just, where was our 1,000 break? Because that was a good break for us. Like right as we broke 1,000, listings have been on a decline ever since.
Yeah.
So we're at 762 listed. Just what, today's the 11th, so over the course of a month we've lost, we've 30% of listings have gone down. So in this month range, 33% of the people who are buying into the project are holding it.
Oh, exactly.
That is bullish.
Yeah, and that's why, like I said, through this bear market, it's about people who are building and shit, and that's why I think it's just like a lot of these NFTs. Like I know you were saying earlier, we were talking in Manix Mints about, you know, like, oh, instead of selling it, I'll just hold it and see what happens, you know, in the bull market, because even if it's 0.2 or 3 and souls, you know, well into like the hundreds again, like that's still, you're still actually up in profit, even though, you know, the soul value is lower, but the USD value might be higher in that. So,
Oh yeah.
you know,
I mean, full transparency, what Den's talking about, I have a shame wallet, meaning a wallet that I regret buying the project of, and I was just so underwater on it that it just didn't make sense to sell for liquidity. So I put it in my shame wallet in hopes that when the bear market ends, I could take advantage of selling it in the bull market. Not a great strategy, but I mean, some things you just, if I'm down like 60, 70% on something, by the time I wake up, I'm like, you're going to my shame wallet. I don't want to look at you. I'm just going to have to hold you and sell you when I can. Don't have too many of them, but yeah, shame wallets are, you know, if you guys ever traded OTC stocks, it's like buying a bunch of penny stocks. And when the bull market comes, I mean, you're going to be up like 200-300%. You can sell them.
yeah.
Like that was a strategy I had for a while, just buy as many 000 stocks as I could, knowing that they weren't diluting and that I could take advantage of them on the next OTC bull market that came. And I did. It was freaking awesome. Like you couldn't even find a 000 stock on the last bull run. Holy crap. I need to get going, gents. We're like 25 minutes past, but thank you all for coming. Lucas, thank you for staying, man. I know it's like 2 a.m. your time. You're a champ for hanging out here. I appreciate you. Sam, thanks for bringing up the topic. I think it's important to understand asset classes, knowing how money is distributed, where it flows in each market. Whether, you know, like crypto's in a bear market, but just keep in mind there is a bull market someplace. There's always a bull market in different asset classes. So I hope you guys found this educational. I definitely want to put some educational content into this channel. I'll pin them just so if you guys want to learn a little bit more, you know, I'll put in some Elliott Wave stuff in here. I'll put in some Wyckoff. I'll put in some different asset classes just so, like, you know, we don't junk up the channels, but, you know, this will be kind of our information center, if you will, just on, you know, different things that we go over. Cool beans. All right, I'm gonna get going. I mean, if you guys have any questions, I mean, feel free to pop them in the Klutch Trade chat. I mean, I always get to those. So if there's anything that comes up or anything that you took away, I mean, I love to know your guys' wins, you know, things that you took away or, you know, things we've gone over that you've implemented and you've seen a difference. I love to know that. All right. Well, I'm gonna get going, you guys. Oh, my pleasure, man. I love hosting these things. So definitely we'll keep them going as long as you guys are interested.
Awesome.
All right, you guys. Much love. I'll catch you guys in chat. Peace.
See you.